I'm Alan Kenny, and we're in New York for REIT Week 2017, NAREIT's Investor Forum. I'm joined by Dean Shigenaga, CFO and Treasurer with Alexandria Real Estate Equities. So, Dean, looking ahead at fundamentals both for the rest of the year and into 2018, how do things look in the life sciences field right now?
Well, I think Alexandria is really in a great position today, and I think there's three key attributes that I think come to mind when I think about where we sit today. First, we've got really strong internal growth. So, for example, our cash same property NOI growth for the last 10 years has been very strong at about 5%. Second, I think we've got a very strong external growth pipeline, which is really the development of new Class A buildings from the dirt, from ground up. And then lastly, I think the third attribute, when you combine the first two, puts Alexandria in a very unique position today. It's really strong market fundamentals. So we're talking about generally very limited supply of Class A space in our markets, combined with very strong demand. Alexandria tends to focus in on collaborative life science and technology campuses and urban innovation clusters across the country. So you're talking about markets like Boston, San Francisco, New York City, San Diego, and Seattle. When you think about market fundamentals, though, again, very limited supply of existing product, Class A product in the markets. Importantly, as you think about new supply coming on, most landlords generally don't have a pipeline that in the near term that will bring new supply on the market. So you're talking about an environment that's very landlord-friendly, very little supply, which means rental rate growth will likely continue into 2017, 2018, and beyond. So I think we're well positioned.
And that supply-demand balance, what does that mean for development?
Yeah, so as you think about that, the backdrop again applies here importantly. So from a development perspective, I think we're really in a really great position. As an example, in 2016, our development pipeline generated 10 new buildings. These are brand new developments, about $92 million of incremental net operating income. Fairly back-end weighted, so it means while large, also contributed to NOI growth going into 2017. As you think about 2017's pipeline, we have 5 brand new buildings scheduled for delivery, about another $100 million of incremental net operating income. Again, fairly back-end weighted, which contributes to NOI growth going into 2018. In aggregate, you're talking about almost $200 million of incremental net operating income. And to put that into perspective, that's roughly 1/3 growth over our net operating income from 2015. But importantly, as you think about, well, what about the pipeline going forward? We're actually in a really good position today. We have a number of extremely well-located land parcels across the country, which really puts us in a position unique within the sector. We control our growth on balance sheet, which gives us the optionality to meet demand for new Class A product from some of the most innovative entities across the country.
And lastly, we've seen some new entrants coming into the life sciences field. So I'm wondering, does Alexandria see the sector getting more crowded, and what does that mean for your strategy?
Yeah, when I think about competition and institutional demand for office lab real estate, I think it really highlights a couple things. One, our business strategy has really worked out very well. Second, I think it highlights the real long-term, high-value nature of the real estate product we own today. As I tie that into our strategy, I think there's really 4 things I'd like to highlight. One, we tend to focus our investment capital in some of the most important urban innovation clusters across the country. Second, we tend to focus our capital on Class A assets, mainly through ground-up development. And, as of today, we have 80% of our annual rental revenue coming from Class A assets in really AAA locations. Third, we want to focus on some of the most innovative entities throughout the world. Really, they're focused on innovation for new therapies and new technologies to really improve the quality of life. Today, 51% of our annual rental revenue is generated from investment-grade rated companies. And I'd say fourth, lastly, really our highly experienced, highly tenured team, I think, sets them apart within the REIT sector today. We're fortunate that they've built some of the most important relationships within the life science, technology, and real estate industries which actually puts us in a great position to capitalize on opportunities going forward. So whether it's a leasing or a new development opportunity, a product of a brand new Class A building, I think our team puts us in a great position strategically going forward.
Well, Dean, thank you so much for your time.
Thank you very much.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.